If you get a chance to delay your purchase, it might be a good time to do it. You might be able to get it a little cheaper in the next 6 months. Those are the words from Robert Shiller in an interview with CNBC this past week.
Maybe if you have a chance to delay your purchase, it might be a good time to do it. You might get it a little cheaper after another 6 months.
Where he said home prices are very high by historical standards and that the downturn is likely to continue. Just after that interview, Shiller released their home price index, which showed that home prices were still up 3.8% nationally year over year, while the FHFA reported a similar increase of 5.3%. But here's the thing. Prices have been slowing since the peak that we saw back in last May. And because of that, both indices were found to be relatively flat since December, with Shiller reporting a small decline of just under 1%, with the FHFA reporting a similar decrease. The Shiller index found that cities in the Southeast were experiencing the highest home appreciation, with Miami leading the way at 13.8% year over year, followed by Tampa, Atlanta, and Charlotte. But on the flip side, the West Coast looks to be the hardest hit, with several cities seeing prices decrease year over year. San Francisco saw the biggest drop at nearly 7.6%, followed by Seattle, San Diego dropping 1.5%, Portland, while Phoenix, Arizona remained relatively flat. So what does this mean for you as a buyer in today's housing market? Should you actually take Robert Shiller's advice and wait 6 months with the idea that home prices are going to be less expensive at that point in time? Well, that's exactly what we're going to dive into right after you hit that like button if you find any value in this video at all. And also do me a favor and feel free to subscribe to the channel to stay updated on everything real estate related. At the moment, the future of the housing market is really sitting in the Fed's hands and what they decide to do with future rate increases, because ultimately what the Fed decides to do is going to have a lot to do with the future of the housing market. This past week, BlackRock warned investors not to bet against the Fed, while at the same time, Fed officials are signaling that additional rate hikes might be needed to fight inflation. On top of that, we have other Fed members saying abandoning the 2% inflation target would be a disaster. And in prior videos, you've heard me talk about the idea of the Fed pivoting, pausing sooner than later, as we're likely to see inflation continue to moderate. In fact, the latest data showed that PCE inflation actually softened in February as consumer spending moderated, with the core rate of inflation slipping to 4.6% versus the estimate of 4.7%. Now, in the past, the PCE data has actually been the Fed's preferred measure of inflation, as the PCE is viewed by the Fed as the best indicator of future inflation trends. So you're probably watching this and saying, why does the Fed look at CPI then if PCE is the best indicator of future inflation trends? Well, that's because last summer, around June or July, the PCE data hadn't yet showed that inflation was going up like crazy. In fact, it didn't report until the CPI numbers reported just a couple of weeks later. So at that point, the Fed pivoted, if you will, and started looking at CPI over PCE. But the main reason they like to look at PCE historically is because PCE uses the substitution method, which more or less means if a family was buying, say, chicken breast for their family and chicken breast got too expensive, they might start buying something like chicken thighs, or a food that was less expensive, or in the case of people buying, say, generic medicine versus brand name medicine. And that's because the PCE takes into account how consumers change their buying habits when prices start to rise. So with that said, we're starting to see inflation come down, which should allow the Fed some breathing room on their super hawkish stance, giving them an opportunity to pause if they feel like raising the Fed funds rate could cause further damage within the banking industry. On top of that, jobless claims for the week totaled 198,000, which was a bit higher than the 195,000 estimate, which at the end of the day isn't a huge deal, but it does show that employment may be getting a little bit worse, which is something that the Fed is paying very close attention to. So with all this craziness happening in the economy, happening in the housing market, should you actually take the advice of Robert Shiller and wait 6 months? Should you buy now? Should you continue renting? Well, let's start by talking about renting. Rent growth just dropped back to pre-pandemic levels. levels. Now, many of you watching the video going, Jeb, my rent hasn't dropped back to pre-pandemic levels. It's significantly higher than it was just a couple of years ago. And that's because we are still seeing single-digit growth in the U.S. rental market. It's just not growing at the rate that it was a year ago when it was up 16.4%. In fact, the median rent across the top 50 metros was up 3.1% year over year. And even though the median asking rent of $1,716 was down by $1 from last month, and down $48 from a year ago, it's still 21% higher than this time back in 2020. At the same time, single-family rent growth was up 5.7% year over year, which is the lowest rate of appreciation since the spring of 2021. But again, still up over 5%. So I know when a lot of people watch my video, they say, Jeb, you're a real estate agent. You're just pushing for people to own homes. You want people to buy homes so that you benefit in some way. Understand, I don't benefit unless you buy a house with me. And most of you watching my channel are spread across the United States. Yes, I am very bullish on housing because I know what it creates long term. And with that said, I don't believe there's currently a rush to go out and buy a house. I actually agree with Robert Shiller when he said that I believe you can wait 6 months. There might be an opportunity for lower prices. But like I've said many, many times before, the direction of the housing market has everything to do with supply and demand, and a lot of that is going to be fueled by interest rates. The average rate on the popular 30-year fixed mortgage started February around 6% and ended the month just over 7%. And during that time, we actually saw pending home sales squeak out a gain, rising for the third consecutive month, up nearly 1% from January. But at the same time, we saw year over year pending transactions drop by nearly 21%, which means there's less people out there buying property. And the primary reason is housing affordability. So why did we see a jump in pending home sales with less transactions happening out there and higher interest rates? Well, as we've talked before, it has everything to do with supply and demand. As you can see from this chart here, national home supply is sitting around 413,000 homes, which is an increase year over year, but down considerably from pre-pandemic. So there's not a lot of property out there for people to buy. And those that want to own homes are having to compete with the lack of inventory that's actually on the market. And that has everything to do with new listings coming on the market. As you can see from this chart here, new listings are down considerably from previous years. But at the same time, it does look like this chart is showing that new listings are starting to increase. In addition to that, we've actually seen the 30-year fixed ease to the lowest level we've seen in the last 6 weeks, sitting at just under 6.5%. So at the moment, we have a tale of two U.S. housing markets, one that seems to be doing relatively well and one seems to be stalling. The one that seems to be doing really well is the ones with the lack of inventory, while the housing markets that have a surplus of inventory seem to be stalling a little bit. And that's why you're seeing headlines like this where it says the U.S. housing market is crashing and soaring at the same time. So what's the right answer for you as a potential buyer out there in this market? Well, as I've referenced a couple of times in this video, a lot of it has to do with interest rates. If you see interest rates move considerably higher, you're going to see more and more sellers out there having to reduce their prices in order to sell their homes. But at the same time, because more and more sellers are sitting out the spring market and not putting their homes on the market, you have a lack of inventory out there. So with that said, I believe that home prices can only go so far down, which means that you're not going to see a crash in housing prices. In fact, I think you've already seen the crash in the housing market, and it's not in prices. It's actually a crash in the number of transactions. In order to have a crash in the housing market, you need a surplus of inventory, which you're not going to see because many sellers out there are locked into super low interest rates and sitting on a ton of equity. But on the flip side, what happens if interest rates move lower? Well, we've already seen as interest rates move lower, you see a pickup in buyer demand. But because there's still a strain in housing affordability, I believe that housing prices can again only go so far, which means that you're likely in a new era of the housing market where things more or less move sideways for the next couple of years, not seeing a lot of appreciation and definitely not seeing a housing crash.